One of the key strengths and points of difference for financial mappers is the very comprehensive set of modelling tools. The only limitation is your imagination. This video is designed to give you lots of ideas on how you can use the modelling tools. Modelling tools can be accessed from any page by clicking the link Modelling Tools are off, may also say Modelling Tools are on. Modelling tools are divided into use of historical data and modulation. Caution should be used when combining the use of historical data and modulators. Reports using modelling tools are accessed in the third panel, Optional Extras. When both the historical data and all the modulators are turned off, the only report available is that called Economic Cycles. This report demonstrates the effect of 4 10-year economic cycles on the results of the first 10 years of your plan. When either the historical data or one of the modulators is activated, you are able to generate reports based on the criteria chosen. It is not recommended that you activate both historical data and modulators at the same time. When you activate any modelling tools, all the calculations throughout your plan will change to meet the criteria chosen for each modelling tool. For this video, Plan D has been created. This is a 20-year savings plan where John has a salary of $150,000 and is allocating 15% of that salary to the investment plan. His assets are home with a current value of $500,000, a 30-year home loan of $100,000, a transaction account balance of $100,000 to be used as a cash account, a share portfolio of $150,000 with 75% of the portfolio having imputation credits and all the dividends reinvested, an investment property with a current value of $300,000, a 30-year investment property loan of $150,000, superannuation of $400,000 with an investment return of 7%. This information regarding the plan is generated by a report called Plan Outcome over 3 time periods. All the information at the start of the plan is displayed. The values at the end of years 1, 5, 10 and 20 are displayed. The challenge can be used to set financial targets for each 10-year period using present values. This information can be found by running your mouse over the present value graphs in the report section of Plan Outcome Summary. For the purpose of this exercise, the exact results have been copied so that these can be compared when activating various modelling tools. While this is not necessary, as the reports show the before and after effect graphically, this may be something you want to check back to so you can see how far the results may vary from your targets. To change from using the standard entries of default specific rate, click the historical data. Here you have the option to select one of the 4 10-year economic cycles. In this case, Economic Cycle 1 has been selected. This is an approximation to the returns and loan costs for the period from 1986 to 1995. Note that you must tick the Activate Historical Data before the changes are applied to your plan. With these economic cycles, the year-by-year returns are used for the first 10 years, and for the remainder of the plan, the average for the 10-year period is used. The graphs are displayed in 3 sections: income, capital growth, interest rate for loans. At the end of any modelling tool page, you will see a set of graphs used to display the indicative effects of selected items for $100,000. The results prior to the change are displayed with a single line and are based on the program's default rates. In this case, the graphs are change in value of a $100,000 property and a $100,000 share portfolio, interest earned on $100,000 using the 5-year bonds and the software's cash rate, monthly payments for a $100,000 home loan with a 20-year term. When you select one of the 4 10-year economic cycles, the change in the value of shares, real estate and cash are displayed. If you click on the inline help, more data is supplied about each cycle. In the 2 examples at the bottom of the page, shares outperformed property in Cycle 1. but their performance was about the same in cycle 3 and the returns were considerably higher than the first cycle. In cycle 4, property outperformed shares. As described previously, these 4 10-year cycles may be applied simultaneously to the plan to show the 4 results overlaid on the original plan. To generate the report, you must select the report type as displayed in the top right-hand corner and press the View Report button. When the report is generated, graphs of the selected changes are displayed. In this case, the changes are for economic cycle 1. This is then followed by a set of 6 graphs showing the before and after. The grey columns are the original plan and the line displays the change. On this page, the results are displayed for net value of assets, net value of home, and value of retirement account. The remaining graphs are change in investment income, investment returns, loan payments, and changes in the debt servicing ratio. This format is used for all modelling tool reports except the one showing the 4 economic cycles overlaid on one graph. In this example, economic cycle 4 was activated and the results compared on the challenge page. As you can see, the returns are substantially less than the target returns, which in this case are the actual returns before the application of any modelling tools. Note that the average real return is minus 2.54% and reflects the effect of the GFC in the first 10-year period. The second selection is using a selection of historical data. Currently, the only historical data supplied by financial mappers is a selection of information which approximates to the Australian historical data from the year 2000. This is updated each year when the information from the previous year is available. When you click Edit button, the values of each year are displayed. The user may edit these values and then reset them. For example, you may prefer to use a property capital growth for the area in which you are buying real estate rather than the average for Australia. Or if you only invest in the top 20 share companies, you may want to use an index for the ASX 20. There will be occasions where reliable information is not available in the public domain, and Financial Mappers has nominated a set return, as is the case for rental income, which has been set at 5%. The net rental income of 4.25% is approximately the same as the dividend return, which again is about 4.25%. In the case of interest on loans, the standard home loan is used as the basis of the calculations, and other interest rates have been raised by 0.5% for investment property, 1% for share portfolio loans, and 3% for personal loans. In the case of managed funds and pension funds, the software has created an asset allocation of the following. For managed funds, 20% cash and 40% each for shares and property. For pension funds, 30% for cash and property and 40% for shares. There is a great selection of options for historical data. You can nominate the data to start from any year from 2000 and nominate how many years of data you want to use. In this example, all the available data is being used, that is, data from the year 2000 to 2016. The data may be used as an average for the nominated time periods, or you can elect to use each year-by-year value. Note that in this case, once the nominated time period has been used, the remainder of the time period will revert to the average for that time period. This can be very useful where you want to evaluate the different outcomes of using average long returns rather than the actual year-by-year returns. In this case, almost 322,000 has been added to the value of the fund where the average returns have been used. Another option is to not use the average inflation rate for the time period. It is not really necessary to use this, but you need to remember that when activated, all your counts will display the new values which have been increased by the new inflation rate. To save confusion, sometimes it is better just to keep the default inflation rate. Of course, your results won't be as accurate, but this is modelling software, and really what we are looking at is the cause and effect of economic conditions on our plan. It has been repeatedly shown that previous returns are not a good indicator of future performance. However, there is value in trying to get some sensible parameters of what future outcomes are likely to be. It is better to be looking at a range of outcomes rather than saying, my plan predicts I will have, say, $2 million in 20 years. The income modulator will raise or lower the nominated returns by the percentage listed in each year. There is a special rule with the income modulator which states that if the modulation results in a negative return, then the return will be listed as 0%. When economic cycles are chosen, the same change is applied to every income in the plan, even where the plan has nominated a fixed income return rather than a variable. With economic cycles, you can choose to commence the selected cycle from any year. The first economic cycle has been created by calculating the variation each year from the average return over the 20-year period. The 90-day bank bill rate was used to create the cycle. The second option is to use default custom modulation. Where this option is used, you can nominate different rate changes for the categories of investment property, share portfolio, managed funds and cash accounts. The program has set a default to show a situation where the interest rates are falling from year 2 and then rising back to the normal by year 9. The last 5 years show the effect of a 2% rise in income. At the bottom of the page are a set of indicative effects of changes in investment income, looking at changes in a $100,000 portfolio for shares, managed funds, investment property, and a cash account. The user can change the default settings. In this case, the income has been increased over the years, reason being that the investor is expecting the current historically low returns to return to more long-term returns. In Plan D, all the cash is held in the transaction account and the default rate is 5.95%. Note that the program will normally fix the interest rate for the transaction account, but in this example it has been made variable. For this modelling exercise only, the interest rate has been changed to 1.5% to reflect current low interest rates and then increased 0.5% each year from year 2 until the interest rate increase reaches 3% in year 9. Note that only the cash account income is being modulated. The report, Plan Outcomes Using Modelling Tools, shows that by year 20, an additional income of around $10,400 would be generated by the increased cash rates. There is a special rule for bonds. When the income modulator is activated, the income for bonds is not changed. Instead, the program will calculate in each bond account the effect of the value of the bond should interest rates change. Financial Mappers does not allow the investor to sell bonds before the maturity date, which is not the case in the real world. In the real world, the value of the bond may be higher or lower than the face value, depending on whether the current bond coupon rate is less, in which case the value of your bond will be more, and if the coupon rate is higher, then the value of the bond will be less. In this example, the bond is a 10-year bond purchased in year 1. Note the change in value where rates are lower and higher than the bond rate. With the loan modulator, the effect of changing interest rates on the loan payments is calculated. When using economic cycles, you may commence the cycle in any year, but you cannot vary the percentage of change. The same rate is applied to all loans, regardless of whether or not the interest rate is fixed. The 3 economic cycles are rising and falling interest rates, high interest rates, and low interest rates. Note the graph at the bottom of the page displaying the change in loan payments for the $100,000 loan. When it comes to custom default loan modulator, there are 2 concepts you need to understand. The variable interest rates only will rise when this option is selected. If you choose all interest rates, both the fixed and variable rates will change. In each loan, you have the option of nominating how long the interest rate will be fixed. The reason for having this option is that you may believe that the current loan interest rates are too far from the average of around 7% for home loans, and that while you want to use the current low rates for now, you want to make accommodation for the return to higher interest rates over the long term. It may be that you choose to keep this option permanently on, or just use it when you want to see how much worse off you'll be when interest rates rise. If you elect to have both all interest rates and variable interest rates activated at the same time, then the variable interest rates will increase by the combined value. The total increase for both fixed and variable interest rates for each year are displayed in the table and on the graph. In the report, Plan Outcomes using Modelling Tools, the rate of change is displayed. In the last graph of the report, the change in both the loan payments and the debt servicing ratio is displayed. In this example, there is both a home and an investment loan, and the loan payments will increase by about $7,120 a year or $590 a month. The Capital Growth Modulator changes the value of assets. Note that pension funds, which in Australia is your superannuation, is included in the Capital Growth Modulator. There is a special rule for pension funds where the income and the capital growth are combined when making the calculations in the fund. The program has chosen to include the superannuation in the Capital Growth Modulator but not in the Income Modulator. Therefore, there will be some discrepancies, but remember, this is modelling software and you should take a fairly liberal view of any calculations made by modulators. We are looking more at cause and effect than exact outcomes. In this modulator, there are two classes, one called real estate, which will apply to both the home and investment properties. The second is referred to as shares and is also applied to managed funds and pension funds. Again, you need to be mindful that both managed funds and pension funds will not necessarily rise or fall at the same rate as equities. The two options may be used together or separately, and each option may select a different cycle. The cycles which can commence in any year for both asset classes are bubble and bust cycle, which has been selected, rapidly rising prices, rapidly falling prices. These economic cycles are based on real cycles. Note how the real estate cycles tend to be longer, but not as severe. The indicative effects of changes in asset value are displayed for the four asset classes. The default Capital Growth Modulator shows the effect of a 15% fall in all assets over a 5-year period from year 4. The report for Modelling Tools demonstrates the change in value of investments, home and retirement accounts over 20-year periods. In this case, the net value of the investments would be worth around $310,000 less. For this example, the investor wants to see the effect on the final results of the plan should there be a 40% drop in the share market in year 15, and then return the following year to the default rate of capital growth, which is 6.75%. The indicative graph is displaying the difference in value of $138,000 by the end of year 20. Note that the value of the share portfolio never recovers to the level in year 14 of about $250,000. The report shows that the value of investments is likely to be about $588,000 less if only the share market falls. However, it is likely that assets held in managed funds and retirement accounts are also likely to fall, but to a lesser degree. Looking at the before and after of the actual share portfolio in Plan D, the value of the share portfolio is likely to be about $565,000 less. These are sobering thoughts for the investor. To conclude our discussion of modelling tools, Plan E has been created. In this plan, there is no home loan and no investment property or loan. The value of the share portfolio has been increased by $150,000 to reflect the net value of the investment property in Plan D. The salary allocation is 70% to the share portfolio and the balance to the transaction account. The statistics for Plan E show a real return of just under 5%. The asset allocation between shares, cash and retirement accounts, together with the investment profile of high growth throughout the plan. The final slide displays the effect of the 4 10-year economic cycles over the first 10 years of the plan. The highest and the lowest value for both plans have been displayed. If you do nothing else with your modelling tools, having a quick review of your plan using the report showing the effect of 4 economic cycles is likely to give you a reasonable range of financial outcomes based on these economic cycles. Modelling tools may be used to build a set of what-if scenarios so you can plan for any unexpected adverse events you or your parents may have experienced in the past. Talking to your advisor about any concerns you may have is a good place to start. Enjoy the magic of financial mappers.